Welcome back to the Deep Dive. Today we're going to tackle a subject that honestly feels incredibly relevant to, well, just about everything we do these
Yeah,
days.
it really touches everything.
It does, because we are living in a world that is just absolutely drowning in data.
Drowning is the right word for it.
Right. And I don't mean that metaphorically, I mean functionally. We are underwater. Think about it. Every time you tap your phone, every time you swipe a credit card, every sensor in a modern factory,
Right.
it's all generating this relentless, just screaming torrent of data. And for most companies, honestly, that data isn't an asset yet. It's a liability.
It's just noise.
Exactly. It's just noise.
It's the paradox of plenty, really. We've moved from this age of scarcity where we just didn't know enough about our customers to an age of overwhelming volume.
Yeah.
The problem isn't getting the data anymore. The problem is that the data is speaking a language that most CEOs simply don't speak.
It's a spreadsheet that goes on forever.
Right. It's unreadable.
Yeah.
And that is exactly where our subject for today comes in.
Yes, LatentView Analytics Limited. They basically position themselves as the translators.
The interpreters of the chaos.
Exactly. They claim to turn that noise into actual, actionable business strategy. Now, just to ground us right at the top, today is February 23rd, 2026.
Right.
And we're looking at the landscape of their fiscal year 2026 performance. And let me tell you, on paper, this company looks like a total miracle.
It really does.
I mean, they don't own factories, they don't ship boxes.
Their inventory.
Right. They sell pure brain power and algorithms to Fortune 500 giants, and they are sitting on an absolute mountain of cash.
It's a fascinating financial fortress, but, and this is really why we're doing this deep dive today, there is a massive existential shadow hanging over them.
The AI shadow.
Precisely. LatentView has grown by analyzing data for humans, using humans. But we are entering a world where machines are starting to analyze data for themselves.
Yeah, the rules are changing.
So the core tension of this deep dive is pretty simple. Is artificial intelligence the tool that makes LatentView unstoppable? Or is it the meteor that wipes them out?
It's the classic adapt or die scenario, but, on steroids. And we have a lot to get through today.
We do.
We need to dismantle their business model because it's often totally misunderstood. We need to look at their moat, or, spoiler alert, the lack of one.
Yeah, we'll definitely get into that.
And we need to look at the money because the margins here are frankly suspicious for a service business.
They are. It's a high-wire act.
Yeah.
And understanding how they stay up there is key to understanding the modern economy.
So let's jump right into the first part, the what and the how, because I really want to strip away the marketing fluff here.
Please do.
Because data analytics and consulting is a phrase that just makes my eyes glaze over.
It's very corporate speak.
It sounds like generic jargon.
Yeah.
So be specific for us. Help us de-jargon this. Is LatentView a software company? Like, are they selling a platform, like a super-powered version of Microsoft Excel that I subscribe to?
That is the single most common misconception.
Yeah.
And it's crucial to clear it up right at the start. No. LatentView is not a SaaS company. They are not selling software as a service. They don't have a login portal where you go and do the work yourself.
Okay, so if I'm a CEO and I write them a massive check, what am I actually buying?
You're buying the outcome. Think of it this way. If you own a gold mine, a SaaS company sells you the shovel and the pickaxe and says, good luck, go dig.
Right.
LatentView doesn't sell the shovel. They sell you the geologist.
Oh, that's a great way to put it.
They send in a human expert who looks at the terrain, analyzes the soil samples, understands the seismic history, and tells you, dig right here, 10 feet down, and you will hit the vein.
That's a really helpful distinction. They aren't selling the tool, they're selling the answer.
Correct. They sell expertise. Their product is predictive modeling, forecasting the future based on past data.
Which is huge.
It is. It's marketing analytics, figuring out why a customer in Ohio buys mint toothpaste while a customer in Florida buys cinnamon. And it's data engineering, which is the unglamorous plumbing required to move that data around so it can even be read in the first place. Plus, now they're heavily into generative AI and agentic AI frameworks.
Which we will definitely get into later. But their name, LatentView, it implies something specific, doesn't it? It sounds a bit mysterious.
It does. Latent basically means existing but not yet developed or manifest.
Hidden beneath the surface.
Exactly.
Yeah.
Their philosophy is that the solution to your business problem is already inside your data, but it's buried under layers of chaos. It's latent.
Right.
Their job is to bring that latent insight to the surface so you can actually use it.
So let's look at the receipts, because promises are really cheap in the consulting world. The source material highlights some specific wins that help make this concrete.
Yeah, let's look at the numbers.
They worked with a major retailer and improved their demand forecasting accuracy by 21%.
In retail, that is an enormous number. You have
Hmm.
to understand, retail operates on razor-thin margin.
Yeah, pennies on the dollar.
Exactly. If you could predict what people want to buy 21% better than you did yesterday, you stop wasting millions on inventory that just sits on a shelf gathering dust.
Right, and you stop losing millions because you ran out of stock when the customer actually walked in.
Exactly. That 21% improvement flows almost directly to the bottom line. It's pure profit recovery.
Okay, here's another one. They helped an insurance company speed up claims processing by 10%.
Which sounds modest, but in insurance, speed is retention.
How so?
Think about the last time you had to file a claim. You were stressed, maybe standing on the side of the road.
Yeah, not a great day.
Right. If I crash my car, the speed at which I get my check determines if I stay with my current provider or switch to a competitor. LatentView is acting as a business mechanic here, popping the hood and tightening the specific valve that makes the engine run smoother.
And there was also a 30% improvement in service accuracy for a manufacturer through diagnostics.
Right, predicting when a machine will break before it breaks.
Which saves downtime.
And in manufacturing, downtime costs thousands of dollars a minute.
So who is paying for this mechanic? Because they aren't cheap. These aren't services for a mom-and-pop shop on Main Street.
No, these are the big dogs.
Yeah.
They're talking Fortune 500. And their revenue split is incredibly telling about who values this geologist approach.
Yeah, the concentration is wild.
About 68% of their revenue comes from the technology sector.
That is a massive concentration risk right off the bat. 2/3 of their eggs are in the big tech basket.
It is. They are essentially a derivative bet on the health of Silicon Valley.
Right.
Now, they are diversifying. Financial services grew 94% year over year in recent quarters, which is impressive growth.
Very impressive.
But they are still fundamentally tethered to the health of the tech giants.
And here's the other concentration stat that really jumped out at me from the sources. LatentView is an Indian company. They are headquartered in Chennai.
Right.
But if you look at where the money comes from, 87 to 90% of their revenue comes from the United States.
This is the geographic arbitrage. This is the entire engine of their profitability. You literally cannot understand LatentView without understanding this dynamic.
Break that down for us. Why is that specific split India HQ U.S. revenue so critical to the model?
It's simple economics. Data science talent in the U.S. is prohibitively expensive.
Right, a top-tier data scientist in San Francisco or New York commands a massive salary.
Massive. If a U.S. company wants to build an internal team to solve these problems, it costs an absolute fortune.
So what does LatentView do?
LatentView charges the client in U.S. dollars at rates that are competitive for the U.S. market. They might be slightly cheaper than a U.S.-based firm, but they're still charging American prices for high-value work.
Okay.
But the people doing the work, the delivery teams, are largely based in India.
So they earn in dollars and pay in rupees.
Exactly.
Yeah.
And that spread the gap between the U.S. billing rate and the Indian cost of delivery is where the profit lives.
It's a classic offshore model.
It is, but applied to high-end specialized work, rather than just call centers or IT support, they are arbitraging intelligence.
Which actually segues perfectly into the next part, the money machine, because the financials and the structure here are fascinating.
They really are.
Because the margins are startling. Usually, service businesses are low margin.
Yeah, traditionally.
You can't scale humans like you scale code. You want to double your revenue in a service business, you usually have to double your headcount.
Exactly.
But LatentView's gross margins are sitting at 60 to 70%.
That is SaaS territory. That is software territory. Investors usually only see those numbers when a company is selling code that can be copied infinitely at zero cost.
So how are they maintaining software margins with a human workforce?
It goes back to that arbitrage we just discussed. Their material costs are effectively zero. They don't buy steel, they don't buy silicon, they don't have inventory rotting in a warehouse. Their cost is salaries. And because they are incredibly efficient at managing that talent utilization, and because of the currency spread, they keep a massive chunk of every single dollar they bring in.
Let's look at the scale here, just to give you an idea of the size. For fiscal year 2025, their revenue was roughly 8.57 billion rupees, which is about 103 million US dollars.
And that is not static. They've shown 11 to 12 consecutive quarters of sequential growth.
That's practically unheard of in consulting.
It's very rare. From FY21 to FY25, revenue grew from 3.11 billion rupees to that 8.57 billion. That's a compound annual growth rate a CADR of about 28%.
That is very fast growth to sustain over 4 years.
It is. And looking at the recent performance, giving us that FY26 context, Q2 of FY26 showed 23.2% year-over-year growth. So the engine is still revving, even as they get bigger.
But the number that really blew my mind wasn't the revenue. It was the net profit margin.
Yes.
They're bringing home almost 20% of their revenue as pure profit, roughly 19.6 to 19.8%.
That is the money machine aspect of it.
Yeah.
But there is another layer to this financial fortress that is rare in the tech world.
What's that?
LatentView is incredibly cash-rich and almost completely debt-free.
Debt-free. In a world where tech companies usually run on massive piles of debt or venture capital cash burn, that really stands out.
It puts them in a very unique position. And look at their cash conversion. More than 90% of their earnings turn into free cash flow.
Okay, let's unpack that for the listener. Why does cash conversion matter? Why is free cash flow better than just profit?
Because profit can be an accounting opinion.
What do you mean by that?
You can have profit on paper, but have absolutely no money in the bank because you had to buy a new factory, or maybe you recognized revenue, but the client hasn't actually paid the bill yet.
Yeah.
That's paper profit. You can't spend paper profit.
Right, you can't pay salaries with IOUs.
Exactly. Free cash flow is the actual money sitting in the bank account at the end of the day that you can use.
Real dollars.
Real dollars. LatentView has very low CapEx capital expenditure. They spend less than 2% of revenue on equipment. They just need laptops and Wi-Fi. So when they say they made a profit, that money is actually available.
And we also saw in the sources that their SG&A selling general and administrative expenses decreased by 12% recently.
Showing they are disciplined with spending. They aren't just growing blindly, they're growing efficiently.
So they are a cash-generating machine with almost zero debt, operating an asset-light model.
A debt-free fortress. In a high-interest rate environment, that is a massive strategic advantage. It means they don't answer to bankers. They answer only to shareholders. They can weather a storm that would sink a leveraged company.
Okay, so we've established that they are rich, efficient, and growing fast. It sounds like the perfect business.
On paper, yes.
But, and there is always a but in these deep dives, we have to ask a critical question.
The but is the most important part.
Which brings us to the strategic moat. Or, frankly, the lack thereof. Because if I'm sitting here with a bunch of smart friends and I see these 60 to 70% gross margins...
You want in.
Yeah. What stops me from starting my deep dive analytics and doing the exact same thing? What is LatentView's actual defense against competition?
That is the billion-dollar question. And if you look closely at the source material, this is where the armor starts to show some cracks. To put it bluntly, there is limited concrete evidence of a sustainable competitive advantage.
Ouch. Limited concrete evidence. That is not what you want to hear if you are an investor looking for a 10-year hold.
No, it's not. Let's look at the arguments for their advantage, the ones the company makes, and then let's reality check them.
Okay, let's do it. Argument number one, they claim AI leadership. They say they are an AI consultant with proprietary agentic AI frameworks.
Right, agentic AI sounds very sophisticated. It sounds like they have a secret weapon.
It implies AI agents that act autonomously to solve problems. Like, they set the AI loose and it does the work.
Exactly. But here is the reality check. Do we have any quantified metrics in the sources to prove they are better at this than anyone else? Do they have a massive patent library that locks competitors out?
The sources say no.
Correct. Do we have a specific breakdown of revenue strictly from these proprietary AI tools that proves clients are paying a premium just for them?
No.
No. So it's a marketing claim, not a proven technological barrier.
That's a buzzword.
Essentially. I mean, Accenture's investing billions into AI right now. LTI Mindtree is massive. Can LatentView really out-innovate a company with 100 times their R&D budget?
It's highly unlikely.
It's a claim without a lot of public proof to back it up as a true moat.
Okay, what about argument number two, cost management? We just praised their margins. Isn't that a moat, being the most efficient player?
It is an advantage, certainly. A 34.49% gross margin on the services side is excellent. But is it a moat?
Explain the difference.
Is it defensible? A moat is something I cannot cross no matter how hard I try. Efficiencies is just something I have to match.
I see.
There is no comparative data in our sources that shows they are significantly more efficient than peers like Tech Mahindra. It might just be the industry standard for this type of offshore work.
So if everyone can be that efficient, then it's not a unique advantage for LatentView, it's just table stakes.
Exactly. It's the price of admission to play the game in Indian IT services.
Okay, argument number three, diversification. They claim to have a diverse client base.
Well, do they? Remember what we said earlier? 68% of revenue comes from technology clients.
Right.
That is a heavy reliance on one single sector. Yes, financial services is booming for them right now, which is great. But we're also seeing that the retail and CPG sectors have seen project delays.
So if the tech sector sneezes or goes through a cyclical recession, LatentView bleeds.
They are very sensitive to the macro environment.
So to the investor or the observer looking at this right now, what does this "so what" mean for the price?
It means the valuation is extremely tricky. The company's valuation right now suggests the market thinks they have a massive moat. They are trading at a price-to-earnings ratio, or PE, of around 36 to 44 times earnings.
Which is high. The S&P 500 average is usually much lower, around 20 or 25, depending on the year.
Much lower. A PE of 40 implies absolute perfection. It means the market expects high growth for a very long time.
The market is pricing them like a sauce company with a defensible lock on the market.
Precisely. And the expert warning here is that this valuation is a premium that requires perfect execution. If it turns out they're just a really well-run consulting firm in a crowded market, that valuation could compress very quickly.
It's a premium price tag, so you expect a premium product. And if the execution falters, the price drops.
Hard.
So if they want to justify that price tag, they need to keep growing. They can't just stand still.
Which brings us to the growth vectors and the future. Where is the new money actually coming from?
There are three main vectors here. The first is the digital shift.
This is the wave they have been riding for years, but it hasn't crested yet. Companies are still moving to the cloud.
Honestly, I feel like we have been talking about moving to the cloud for a decade. Are companies really still doing that? Haven't they all moved by now?
You would be surprised, a lot of the easy stuff has moved, email, basic file storage, that kind of thing.
Sure.
But the complex core business data, the legacy systems that run old banks and hospital networks, that is still migrating. LatentView partners with platforms like Databricks and other cloud providers.
Why Databricks?
Because as Databricks grows and sells more cloud storage and processing, LatentView grows because someone needs to implement those tools and make them actually work for the client.
Okay, so riding the coattails of the cloud giants, it's a symbiotic relationship. Databricks sells the storage, LatentView organizes the closet.
That's a great analogy.
What's vector number two?
Ecosystem expansion. This is really interesting. They're moving beyond just analytics, which is looking at the data into full-blown data engineering.
Which is fixing the data plumbing.
Right. And they're using a model called build, operate, transfer.
Build, operate, transfer. How does that work? That sounds like a heavy construction term.
It does. Imagine a large U.S. bank wants to build its own innovation hub in India to save money and own their own IP. They don't know how to hire in Chennai or Bangalore. They don't know the real estate market or the legal compliance or the tax structures.
It's a headache.
A massive headache. So LatentView says, we will build it for you. We will hire the team. We will operate it for a few years, get it running perfectly, and then we will literally transfer ownership of the whole thing to you.
Wait, they build a revenue stream and then give it away? That seems completely counterintuitive.
It's a strategic trade-off. You get a massive guaranteed contract for several years to build and run it.
Sure.
But yes, eventually you lose that specific operating revenue stream. But the theory is, once you hand over the keys, you have embedded yourself so deeply in that bank's ecosystem that they keep you around for the high-level consulting anyway.
Got it. It's a foot-in-the-door strategy, but on a massive corporate scale.
Exactly.
And vector number three involves their checkbook, acquisitions.
Yes, specifically, the sources highlight the acquisition of a company called Decision Point.
What did Decision Point bring to the table? Why buy them?
Two big things. First, it helped them grow in the CPG and retail space.
Consumer packaged goods.
Right, which helps diversify away from that heavy tech reliance we were so worried about earlier.
Ah, smart.
And second, it added nearshoring capabilities.
Nearshoring. Explain the difference between offshoring and nearshoring for us.
Offshoring is India. Great cost advantage, but bad time zone overlap. When you are waking up in New York, your team in India is going to bed.
Right, communication lag.
Nearshoring usually means Latin America.
Yeah.
You are in the same time zone as New York or Chicago. It allows for real-time collaboration during regular business hours while still getting a cost advantage over U.S. hires.
It bridges that time zone gap. That makes total sense. But all of this relies on one fundamental thing: people.
The human element. We cannot forget that at its core, this is a people business. They have roughly 3,000 to 4,000 employees.
And the metric that matters here is revenue per employee.
Right. They are generating about 20 to 25 lakhs per employee. To keep those beautiful 60 to 70% margins we talked about, they need to keep their utilization rates incredibly high.
Utilization rate is basically, are you billing a client right now or are you sitting on the bench?
Exactly. If you're on the bench, you're costing the company money. They need to keep that rate at 70 to 80%. If it drops, those margins vanish instantly because they are still paying the salaries.
It's a constant balancing act.
It really is. Hiring enough people to grow and take on new projects, but not so many that you have people sitting around doing nothing.
It sounds stressful.
It is the consulting treadmill. You can never, ever stop running. You have to feed the beast constantly.
Okay, so we have the business model, the money, the moat or lack of it, and the growth plan. Now, let's talk about the elephant in the room, the risks. Because as good as this story sounds, there are some very dark storm clouds gathering that we absolutely need to talk about.
And the biggest storm cloud is the very technology they are selling, AI commoditization.
This is the part that keeps me up at night regarding this whole industry. If AI gets really, really good, do companies still need consultants at all?
This is the highest impact risk, bar none. Let's look at scenario A, Gen AI replacement.
Walk me through that scenario.
Right now, a client hires LatentView to build a predictive model to forecast sales. That involves a team of data scientists writing code in Python, testing models, refining parameters.
It takes weeks, maybe months of billable hours.
Right. But look at where open source LLMs, large language models, are going. Look at what is happening on platforms like Hugging Face.
Yeah, it's moving fast.
We are getting to a point where a business executive could upload a raw data set to a secure, private AI instance and just type, "Forecast my sales for the next quarter and tell me which variables matter most."
And the AI does it.
The AI does the coding, the modeling, and the analysis instantly.
So the geologist we talked about earlier, the AI becomes the geologist.
Exactly. The expertise that LatentView sells, the coding, the modeling, is exactly what AI is getting very, very good at doing automatically.
Wow.
If the insight becomes a commodity that you can get for free or very cheap from an AI, LatentView's value proposition collapses. They are selling a premium service that might soon be a basic feature of the software.
That is terrifying for them. It completely cannibalizes their core service.
It is. And then there is scenario B, the hyperscalers.
You mean Amazon, AWS, and Microsoft Azure?
Right. These companies host the data. If Amazon or Microsoft decides to bundle advanced analytics tools directly into their cloud storage for free, or even as a tiny add-on, why would you ever hire a third-party consultant?
You wouldn't.
The middleman status of consulting firms is under severe threat.
It's like when Apple adds a flashlight app to the iPhone. Suddenly, every flashlight app developer goes out of business overnight.
Precisely. LatentView is currently selling a premium flashlight app. AWS owns the phone. That is a very dangerous place to be.
That is a stark analogy. Is there evidence that this is actually happening right now?
The evidence is in the nature of the work itself. The services LatentView sells, predictive modeling, coding, are the exact tasks that are most vulnerable to automation. They are not digging ditches, they are manipulating symbols. And AI loves manipulating symbols.
Okay, so that is the existential threat. But what about the day-to-day threat? Just regular competition.
The market is highly fragmented and has very low barriers to entry.
Anyone with a laptop can claim to be a data consultant.
Right. And you have the huge Indian IT giants on one side, TCS, Infosys, Wipro.
And they have massive scale.
Unbelievable scale. They can undercut LatentView on price all day long. If a client just wants good enough analytics, TCS can do it cheaper.
And on the other side,
You have the niche startups. Small teams of 5 people with a cool new AI tool that allows for faster prototyping. They can move faster than LatentView, so LatentView is squeezed in the middle. Too small to fight a price war with TCS, maybe too big to move as fast as a hungry startup.
we also need to touch on key person risk.
Yes, this is a founder-led company. The culture is very much built around specific leaders, including the CEO, Rajan Sethuraman.
And in a relationship-based business, people matter. Clients buy the person as much as the firm.
Exactly. If the head of the financial services vertical leaves, and remember that vertical just grew 94%, does the client relationship leave with them?
It often does.
That is a huge risk. We've seen it happen in other firms a million times. A leader leaves, starts their own boutique shop, and takes the biggest client with them.
And finally, are there any financial red flags? We said earlier they are a fortress, but are there any cracks in the wall?
There are signs of margin compression.
Meaning margins are getting squeezed.
Yes, operating margins dropped recently from around 23% down to around 21%.
Why the drop?
Higher tax rates played a part, but mostly it's wage inflation. As we discussed, talent is their primary cost. If data scientists demand higher salaries because they know they are valuable, margins go down.
Right.
And with the stock trading at a high multiple, a price-to-sales ratio of 8.8 times versus the sector average of 1.2 to 1.4 times, the stock is priced for perfection. Any slip in margins, any slowdown in growth, and the stock price could take a significant hit.
So let's bring this all together. Let's synthesize everything we've talked about today.
Okay.
We have LatentView Analytics, a math wizard company making millions by helping U.S. giants think clearly about their data. They are highly profitable, they are growing fast, they are totally debt-free. On paper, it is a beautiful business.
It is. It's a very well-oiled machine, but it is a machine swimming in dangerous waters.
Yeah.
The very technology they sell, AI, is evolving so fast it threatens to automate their own jobs. They are in a race to reinvent themselves.
They have to move from being the people who analyze data to the people who control the AI that analyzes the data.
Exactly. And they have to do it before the clients figure out they can just do it themselves.
It really is a fascinating moment in time. February 2026 feels like a tipping point for this entire industry.
It does. It feels like the calm before a very specific type of storm.
So here is my final provocative thought for you, our listener, to mull over. LatentView helps companies predict the future. That is literally their job. But can they predict their own?
That is the ultimate question.
As AI moves from being just a tool to being an agent, something that can think and do on its own, will consulting firms like LatentView become the pilots of the AI guiding it? Or will the AI eventually learn to fly itself?
And if the plane flies itself, you don't need a pilot. You just need a destination.
Exactly. Something to think about the next time you look at a spreadsheet. Look at the data in your own life. What latent insights are you missing? And who or what is going to find them for you? Thanks for joining us on this deep dive.
Goodbye.